The days of going to school, getting a decent job, and living a comfortable middle-class life are officially over. And ironically, the more you work for that comfortable middle-class life, the more uncomfortable you'll become. I'll show you. If we go back in time and look at how incomes have changed over the last number of decades, in the mid-1960s, the average CEO was paid 20 times more than the median employee at their company. But then if we fast forward to 1989, by then the average CEO was paid 59 times more than their median employee. And then by 2021, the average CEO was paid 399 times more than the median employee. So incomes for certain positions have grown way faster than other positions. That's part one. Part two is who owns and controls the wealth in our country. This is a chart from the Federal Reserve Bank showing the distribution of wealth in America over the last 30-some years. And if we go to the year 1991, what you'll see is that the 0.1% of America controlled 8.9% of the total wealth. The following 0.9% of America controlled 14.2% of the total wealth. And then the following 9% of America controlled 36.6% of the wealth, which adds up to the top 10% of America controlling 59.6% of America's wealth in 1991, while the bottom 50% controlled 3.8% of the total wealth. Now let's compare those numbers in 1991 to more recent numbers 30 years later in 2021. In 2021, the top 0.1% controlled 12.7% of the wealth in America. The following 0.9% of the wealthiest people in America controlled 18.9% of the wealth in America. And then the following 9% of the wealthiest people in the country controlled 38% of the wealth, which means that the top 10% of Americans controlled 69.6% of the total wealth in America, while the bottom 50% controlled 2.3% of the total wealth. Now, if you're like me and you have a bad time remembering numbers, let me show you what this means. That means the bottom 50% of America went from controlling 3.8% of the total wealth in 1991 to 2.3% of the total wealth in our country, while the top 10% of America went from controlling 59.6% of the wealth in America in 1991 to 69.6% of the wealth in the country. So we're starting to see now not just a divide in incomes, but also a divide in wealth over the last number of decades. And then we have to look at part three, which is the disparity between cost of living, wages, and asset prices, which is arguably the most important and the least talked about factor. In 1971, the median household income was just over $10,000. This is according to the United States Census. And interestingly, in 1971, that was the first time in American history that the median household income passed $10,000 in 1 year. Fast forward to 2021 and the median household income grew to just over $70,000. Now, a little bit of a disclaimer here because the median household income takes a look at the total household income, and in the early 1970s that was primarily based off of one person's income, because in the early 1970s one person went to work and generally the other person didn't, and in the 2020s generally two people in a household went to work. So yeah, we saw a growth in household income by around 700%, but you have to take that with a grain of salt because you have to remember that the growth in the household income is also partially due to the fact that now we have two people working instead of just one people working in a household. But now let's compare this growth in income with the growth in the cost of living. Between 1971 and 2021, the average price of a new car went from $3,700 in 1971 to around $48,000 in 2021, which is a growth of 1,300%. At the same time, Disney World tickets went from $3.50 in 1971 to on the low end of $109 in 2021, which is a growth of 3,100%. Now, I understand I'm just cherry picking a few items to compare household income to, but you have to understand that even if you look at the general inflation numbers, household income on average has not grown fast enough to keep up with the inflation that we've been seeing, because guess what? Inflation didn't just become a thing after the pandemic. Inflation was around since the 1970s and even before then, but it really ramped up in the early 1970s. Most people didn't know it was happening because inflation was at a low enough number that most people never even noticed it, but it's been around, and that's been eroding the purchasing power for the average person. But the more important part isn't just comparing your incomes with with the cost of living. It's also looking at incomes with the prices of assets, because if you've been following this channel, you know that assets are how you become wealthy, owning the investments. And you need to also take a look at how investment values have inflated over the years, because that makes it more difficult for the average person to invest if asset prices are higher. Now, we did a full deep dive of this in Market Briefs, but let's take a look at the numbers. As a reminder, as a point of comparison, household income grew by around 700% between 1971 to 2021, and median home prices that were sold grew from $28,300 in 1971 to around $346,000 in 2021. That's a growth of home prices by 1,200%, and the Dow Jones went from around 900 points in 1971 to over 34,000 points in 2021. That's a growth of over 3,700%. Now you can start to see why more and more Americans are struggling financially, even though most households have two people working versus before it was just one person working, because for number one, the wages for certain positions have grown so much faster than other positions. Number two, the concentration of wealth has skewed more towards the wealthy. And number three, we've seen a growth in the cost of living faster than average wages. And not just that, the cost of assets, the cost of investing has also grown significantly faster than wages and income. Now, when most people hear this, you get angry, you get upset, you cry, you complain. But the reality is, I'm going to be completely honest with you, that doesn't do any good. It's not going to help your bank statement. It's not going to help your credit card statement. It's not going to help your future wealth complaining about the problem. But what will help is you understanding what's going on, understanding the trend of the economy, understanding what's going on with our money. And once you understand this, getting more financially educated, that way you can then take advantage of what's happening. Because if you stick with me through this video, I'm going to talk about the different things that you can do. That way you can win in this economic system despite all of this happening. Because let me tell you something that a lot of people in power don't want you to know. The system is designed to benefit the wealthy and the financially educated, which means if you're not wealthy yet, you can still take advantage of the way the system works if you understand how the system works. And that means you have to be financially educated, but that means you have to understand and work on three things. Number one is you have to understand how to win in this economic system. Number two is you have to know how to earn money the right way. And number three is you have to know not just how to keep your money, but you have to know how to grow your money without you physically having to grow it yourself. Let me start by talking about number one, which is understanding how to win in this economic system. Now, before I jump into that, I do want to let you know that if you are interested in staying up to date on what's happening in the top finance and business news, I created a free newsletter called Market Briefs as a way to keep you updated on what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy. That way you don't get blindsided by what's happening in the economic world. Even if you didn't grow up with a financial background, it's super easy to understand. It's a super fun read, and you can read it in less than 5 minutes every morning. Market Briefs is completely free, and if you want to join, you can go to briefs.co/market. That's briefs.co/market, and I also got the link for you down in the description below. We live in what's called a capitalist system. Now, in today's economy, that word capitalism draws a lot of emotion, a lot of political heat, because either people love it or people hate it. Now, I'm going to talk to you from a strictly financial perspective, because growing up, I had no idea what capitalism meant. And when I went to college, that was the first time I started hearing people talk about the word capitalism. And either some people were protesting against capitalism, and then you had the anti-protesters protesting for capitalism, but I never understood the concept. And what I want you to understand is the financial meaning of a capitalist system. That way you can understand how to win in the capitalist system, which you would think, if we live in this type of economic system, that our schools would teach how the economic system works, but that's a topic for a different video. Anyways, there are two things you have to understand about a capitalist system. Number one is the income, and number two is the taxes. Because number one is there's more than one way to get paid. See, we go to school thinking that the way you get paid is by going to school, getting a good degree, and getting a good job. But that's not how you can get paid in a capitalist system. In fact, there are more ways that you can get paid than just getting a good job. And that's how the people that understand and can win in this economic system can actually win financially, because they don't just rely on their income. And then second is the taxes, because our tax code is designed to benefit certain people, the wealthy, the financially educated, the investors, the business owners. Well, it's hurting people who don't understand the system, who are just working their job. And I'll show you exactly what that means. So starting with income. In the capitalist system, there's two ways you can get paid. You can get paid from your labor, and then you can get paid from your capital. And we're taught to get paid from our labor. When you go to school, to get a good degree, to get a good job, whether you're becoming a doctor or whether you're an engineer, whether you're an attorney, whether you're an accountant, whether you're a cashier, it does not matter. When you go to work and you get paid a salary or you get paid hourly, that's you getting paid for your labor. You're getting paid for your skill set. That's the first way that you can get paid. But the problem with getting paid from your labor and your skill set is it relies on you going and doing some task. It relies on you doing something. And if you stop working, or if your company goes bankrupt, or if you can't work anymore, your income also goes away. So the first way you can get paid is your labor, but the second way that you can get paid is from your capital. Now, if you didn't guess it already, in a capitalist system, the people that get paid from your capital have the ability to earn even more money. When you get paid from your capital, that means you're getting paid from the money you deploy, not just from your labor, not just from your hours, not just from your skill set, but from the ability of putting your money to work. Now, this is where a lot of people assume that you need to have tons of money to start taking advantage of this system, but that's not true. You can start with as little as $100, even $1, thanks to technology nowadays. The more money you have, the more impact, the more returns that you can get. But that doesn't mean you need a lot of money to start. You just have to get started. I'm going to talk more about how you can invest your money in just a little bit. But let me diagram the real impact of this capitalist system, talking about the income and then talking about the taxes. If we look at the Coca-Cola Corporation back from 2021, what you'll see is that the average worker in Coca-Cola, whether it's from the factories to the corporate headquarters, the average worker in Coca-Cola made somewhere between $30,000 to $180,000 in a year. Now, if you worked to climb the corporate ladder, yeah, maybe you'd be making a six-figure salary. Maybe you're working at the headquarters and making some good income, but you're not making as much as what I call the thinkers. The thinkers are the executives. These aren't the people that are bottling Coca-Cola caps and bottles. These aren't the people that are thinking about the new marketing strategies. These are the people that are implementing the ideas of where to take Coca-Cola and which marketing departments to take it to, which parts of the world to take Coca-Cola to, how to reformulate the strategy. These are the executives, the C-level executives. In 2021, the CEO of Coca-Cola made just under $25 million in that year. Now, part of that income was from his salary, part of the income was from his equity, from his ownership in the company, but he made just under $25 million a year. But then you have the third person in Coca-Cola. Now, you might think that if you're the CEO of Coca-Cola, you don't have a boss. Well, you do have a boss, even if you are the CEO of a company. The CEO of the company is working for the owners of the company. The owners of the company are the shareholders of the company. And who are the shareholders? Well, anybody can be a shareholder, Coca-Cola. If you own one share of the Coca-Cola stock, you are one of the owners of the Coca-Cola company. And one of the biggest shareholders of the Coca-Cola company is none other than Warren Buffett and his company. Well, in 2021, Warren Buffett made just over $700 million in dividends from Coca-Cola. He didn't have to go into work to bottle or package any Coca-Cola cans or bottles. He didn't have to go into the corporate headquarters to come up with new marketing ideas. He didn't have to go in and do the work. Instead, he owned the company and he got his share of the profits. That's what dividends are. Dividends are cash payments that you're getting just for owning a piece of the company, and he didn't have to sell any of the stock to get that money. Now, of course, he had to own billions of dollars worth of Coca-Cola to get that type of ownership return, but what you see is that he's able to make more money than the top dog at Coca-Cola because he's not working for a salary. He's working for his equity. He's working for his ownership. He's working for his profit distribution, which in this case is through dividends. But it gets a little bit more interesting, right? This is the income part of the capitalist system. The second part is understanding the tax side, because like I was saying, the tax code is designed to benefit certain people more than others. Why? Because a tax code has three general categories of income. It has earned income, it has portfolio income, and then it has passive income. Your earned income is the money you make from your job. Your portfolio income is the money you make from something like your stock market investments. And then your passive income is your income that you would get from something like a rental property. And do you know which type of income has the highest tax rates and the lowest amount of tax write-offs and the lowest amount of tax deductions? I kind of gave it away, but that is your earned income, the money you make from your job. Just take a look. In this Coca-Cola example, The workers making $30,000 to $180,000 a year are going to be paying somewhere between 15 to 30% in taxes, depending on how much money you make and where you live. The CEO, who's making millions of dollars a year, is going to be paying somewhere between 39 to 52% of his money in taxes, again, depending on where you live when you earn that much money. But when you are the owner and you're making this money just from owning the company, not from working in the company, well, now Warren Buffett's top tax rate was 20% because he made this money from his investments, not from his labor. Now, yeah, there can be sometimes a small investment premium tax, a few percent, but in general, your top tax rate is 20% when you make your money from an investment that you own, rather than something that you're working for, rather than something that you're trading, rather than something that you're flipping. When you own money from an investment, you can pay less money in taxes while earning more money. This is the first thing that you have to understand if you want to be able to win in this economic system, which is you don't just want to get paid from your labor, you have to get paid from your capital as well, because number one, it's going to allow you to earn more money, and number two, it's going to allow you to take advantage of the tax code that we have here in the United States. And I can tell you this as an attorney who's not your attorney, but our tax code benefits the investor, our tax code benefits the business owner. And if you live in the United States, you need to be a business owner. Now, this doesn't mean you need to go out and operate a business. This does not mean you need to go out and start a business. In fact, most people should not be in the business of trying to operate or start or manage a company. But you can still own a business without having to work in trying to manage and operate the business by owning a piece of it. That means deploying your capital, putting your money to work, that we own a piece of the business. This brings us to the second thing that you need to understand, which is how do you earn money the right way? Now, if you went to school, you got a good degree, you got a good job, and you're happy with the income that you're getting, then fine. No big deal. If you're making enough money to live your life financially, if you're making enough money to put money away for your investments, if you're making enough money to put money away from your retirement and your wealth and your vacations, and you're comfortable with how much money you're making, then this part does not apply to you. But if you are not happy with how much money you're making, either because you're not living the lifestyle that you want, or because you don't have enough money to invest, you don't have enough money to save, you're going to have to work on your money. Now, the first thing that I always say, before you just go and try to earn more money, is you got to get your money right in the first place. That means you have to be able to live below your means no matter how much money you're making, whether it's $20,000 a year or $200,000 a year or $2 million a year. You have to know how to strategically use your money, because if you don't, statistically, what we've seen here in the United States is as people make more money, you dig yourself into a deeper financial hole, because now as you make more money, you become a bigger line of credit, a bigger investment for the bank, because when they see you make a lot of money, they're going to be willing to give you more money. I was recently at a conference and I met a couple people actually who had these big exits in their companies. One guy, he sold his company for a few $100 million. And he owned pretty much the entire company. So his bank account literally had hundreds of millions of dollars sitting there. And he knew how to make his money, but the problem with him was he didn't know how to keep his money or grow his money. And so what happened? He got approached by a lot of very expensive financial managers. He got approached by a lot of banks telling him that he needed to go into debt, he needed to go into margin and invest his money. So the banks worked with the financial managers now to take this money that he had and deploy it in a lot of different places with the help of debt, with the help of margin. And this was just before the 2008 crash. So what happened? Well, he started buying real estate. He started buying stocks because he wanted to leverage up his investments. Again, he was a very good entrepreneur, but he did not know how to manage and invest his money. That wasn't his skill set. So he just went out to people who he thought were educated and smart in that field, and he lost a huge portion of this new wealth that he had built. Now, he was able to grow it again because he was able to build more businesses. He knew that skill set, but he learned a very painful lesson, that you have to know how to use your money smartly. And that doesn't just mean how to invest your money smartly, but you have to start with how to spend your money smartly, because the world is in the business of trying to get you to open up your wallet and give them your money. Period. Every business is in the business of trying to sell you stuff. Every salesperson is in the business of trying to get you to buy more. Every insurance person is in the business of trying to get you to buy something. Every bank is in the business of trying to get you to lend and borrow money. That's how these businesses make money. Does that make them evil? No. That's how these businesses work. So what you need to do is have that financial education of being able to put up and shield and understand, okay, these people, the rest of the world want my money. Fine. I have the ability to spend money, and I also have the control of where I deploy my money. There's nothing wrong with spending money. I mean, that's why you work for money. You want to just know where it's worth spending your money and when it's a good time for you to spend money and how much to spend. So you have to be able to put up that shield and have that basic level of when is it okay for me to spend and how much can I spend. I'm not going to go deeper into that in this video. I have a lot of videos on my channel talking about how to spend. You can check those out. But then the next thing is, if after that you say, yeah, I'm living below my means. I have some money to put aside towards my investments and my savings, but I'm still not living the lifestyle that I want. And I want to be able to invest my money more aggressively. I want to be able to build my wealth faster. How can I do that? Yes, it is possible, but that's going to require you to put more fuel on your investment fire, meaning earn more money so you have more money to invest. And how do you earn more money? Well, you can obviously do that through your job. You can work to get a raise. You can get a promotion. You can work to get a second job. You can work to get a certificate. You can work to get a new career change. There's never too late to make a change. That's the first thing that you can do. But I'm not an expert at that. But what you can also do is you can also work to create your own income. This is something that I understand more of because it's something that I've done multiple times throughout my career. In today's day and age, hate it or love it, we are living in the internet age, which means there are a lot of ways for you to earn money through the internet or use the internet to leverage your income from opportunities outside of the internet. Like if you have a landscaping company and you want to make more money, well, you can use the internet to leverage how much money you're making in the landscaping company. But you have to understand and be able to utilize the internet. That way you can scale your income. How do you do that? Well, on the internet, we live in this attention age. Every single application, every single influencer, every single thing on the internet is fighting for your attention and time. YouTube is monitoring channels' growth through watch time and retention time. They want to see how many people are getting people to watch your content. Threads is fighting Twitter for how much people spend time on their app versus Twitter. Every social media is fighting for your time. So now what your job isn't to necessarily go out and create a new application unless there's something you're interested in and something you want to do and you can create some value in that, but rather, how can you create some content on these other platforms that will grab somebody's attention? Now, this doesn't mean you have to go out and do some crazy stuff, go to Walmart and open up cans of milk, jugs of milk, and start dumping it everywhere. I know that's what some people do, but that's not the type of attention you necessarily need or that's going to drive you any revenue. What you need is to provide value to a certain type of person that will want to watch your content that you can then monetize. Now, there's a lot of different ways that you can monetize. You can monetize through advertisements. The more people that watch your content, the more money you're going to make. You can monetize through affiliate partnerships or sponsorships. You can also monetize through selling your own product. In this day and age, the name of the game is attention. And every company, which you're going to see going forward in the next decade, every company is going to have their own media distribution platform, because back in the day, when a company wanted to get more sales, what did they do? They had to run TV commercials. They had to go and buy billboards. They had to go and buy signs in cities. Today, it doesn't work like that. People are paying influencers to get that exposure, or they're running advertisements on YouTube. They're running advertisements on Instagram. They're running advertisements on Facebook and Twitter. So now what companies are seeing more and more, and what they're going to see over the next decade is, yeah, we can go out and pay influencers to get this exposure, or we can try to build our own influencers within our own network. And you're going to see more and more companies that are going to work to build their own distribution platforms, meaning companies are going to try to get their own attention. Now, is that going to be enough? No, you're always going to see this thing where influencers are going to get paid to support and be an ambassador for companies. But even if you don't want to be an ambassador for other companies, you can be an ambassador for yourself, your own brands, your own products. Because if you're investing into your own personal brand, you can't lose. Because if you're getting more known and more people know you, more people watch you, more people know about you, well, that's more people who know who you are. That's more people who can buy your book. That's more people who can buy your products. That's more people who can buy your education. That's more people that can buy your service. That's more people that can buy whatever it is that you have to offer. Now, what does this mean in terms of dollars? On YouTube, if you go out and publish a video that gets, say, 1 million views, you're going to make somewhere between $7,000 to $15,000 generally in advertising off of the 1 million views. Now, the exact amount of money you make is going to depend on a lot of different factors. It's going to depend on, number one, who's watching it. Are they a bunch of 13-year-olds, or are they 25-year-olds who have money? Are they people in the United States, or are they somebody in a third world country? So these factors are going to play a big impact as to how much revenue you make. And then the question is, how do you actually monetize within the video? Because what you see is on this video, there are advertisements. I don't have to go out and do anything. YouTube just puts advertisements on my video, and we get a piece of that revenue that YouTube generates. So there's nothing that you have to do to generate the advertising revenue. The next thing that you could potentially do is you can sell sponsorships on that video. If you can generate 1 million views, you can pretty easily charge $10,000 for a sponsorship. Maybe a lot more, again, depending on what types of audience you have, but pretty comfortably you can sell a sponsorship for $10,000, if not a lot more. But let's assume that you sell it for $10,000. That means you can get $10,000 from the advertising revenue, another $10,000 in sponsorship revenue, and then you also have the ability to market and sell your own products. Now, this could be really anything. It could be a class. This could be coaching, this could be consulting, this could be a physical product that you created. This could be whatever you want. And if you know how to build and market your products the right way, you can pretty comfortably double the amount of revenue you're making from your advertising revenue from selling your own products, because now you are a promoter of your own products. So you can make $10,000 from the advertising revenue, another $10,000 in sponsorship revenue, and another $20,000 or so from selling your own products, which means 1 million views could bring you roughly $40,000 worth of revenue. Now, you might hear this and say, oh my God, I need to go out and create a video with 1 million views and then put as many sponsorships and product promotions in there as possible. But here's a little tip. If you go out and you make a video that has all these advertisements and sales pitches in there, nobody's going to watch it. In fact, people hate advertising so much that they are willing to pay money to avoid seeing ads. How do I know? Because YouTube has their YouTube Premium features where you can pay money to YouTube to avoid seeing YouTube ads. Now, what are you doing? You're paying money to not have to spend time watching the advertisements. It's just like Netflix. Netflix has their cheaper option, which is where you see advertisements. And then they have the premium options where you don't get to see the advertisements. People will pay money to avoid being advertised to. So if you're in the content game and you're constantly selling, well, you're going to have a very hard time actually making any real money because you're constantly just trying to sell. You're not making content for the purpose of actually building value. When I started my YouTube channel, my goal wasn't to make money. And you might hear that and say, that doesn't make any sense. I created this channel because I got screwed over in a different business that I was running. So I started making videos on how to launch a business without getting screwed over so people could learn from my mistakes. I didn't even know that you could monetize your channel. My channel had grown to over 10,000 subscribers, and somebody had to tell me that I could push a button and start running advertisements on my channel. I did not know that you could do that. I just started creating videos because this is something that I wanted to do. So when you go in, especially with YouTube, especially in the content game, if you go in with the mindset of just trying to create organic content to sell your stuff, you're going to have a hard time getting people to want to watch it because people don't want to watch sales pitches. They want to get some sort of value. Maybe this value is entertainment. Maybe this value is education. What is the value that you can provide that somebody would actually want to watch? In fact, just ask yourself, would you go out of your way to watch your content? If it's boring, if it's not providing any real education, if it's just selling a bunch of crap, you're not going to want to watch it. And that's probably why people aren't watching your stuff then either. So this is where now, if you want to get into that type of content game, understand how do you get somebody's attention and how can you provide value? And another skill that you can also work on is your sales. You've probably heard a lot of people on the internet talking about how knowing how to sell is one of the most fundamental parts of being an entrepreneur. And I'm going to be very honest with you. I think I am a decent salesperson. But the thing that holds me back from actually succeeding as a salesperson is I'm always thinking about the other party. If you're buying something from me, I'm always thinking, can you afford what it is that I'm selling you? If you cannot afford it, I don't want to sell it to you. I, in that sense, am not a good salesperson. Even when I used to be a real estate salesperson, I used to steer people away against the more expensive homes because I felt like it was too out of their budget. People would want to buy the big home. The bank would get them approved for it, and I would be the one saying, I don't know if you should buy that big of a home because that's going to really hurt your ability to invest your money in the future. That was my problem. That's why I was never a good salesperson. Now, I'm a much better marketer. I know how to create good content. I know how to make something attractive, but I'm not a good salesperson. And even on the internet, when I go to sell things like educational products, I have rules like you're not allowed to go and purchase this product if you have credit card debt. We have turned away tons of money, probably $1 million plus worth of revenue, because I refuse to accept educational sales for educational products like classes if you have credit card debt. We've turned away a lot of sales just because I'm not trying to maximize the revenue. I don't like selling in that way. That's just not my style. Now, I know some other people would completely disagree with me. That's okay. But that's just not the way that I do things. But the way that I make up for my inability to sell is with my ability to market. I do a much better job at marketing. I like creating fun advertisements. I like being able to integrate product promotions into my videos. You've heard me talk about my Briefs media company probably, I don't know how many countless times in my videos. Well, why? Because I can integrate it into my videos. I talk about what's happening in the financial news and education space, and I use that as a lever to then promote my own company. Is it a commercial? Yeah, but it doesn't get the same negative feedback as a traditional commercial would. And so this is where now the art is, how can you find the right balance of selling versus marketing, and how can you promote whatever it is that you want, whether it's sponsors, whether it's your own company, whether it's just your own content. How can you find a way to leverage the revenue from the content that you're putting out? There's no secret sauce to this. There's a lot of different ways to do this, but you have to find what's right for you and what's natural for you. For me, it's not being a hard seller and a hard closing person. That's just not the way that I am. I don't feel right doing that. For others, that is. They love the ability of trying to sell you and get you to take action, because without paying, you don't pay attention and all that stuff. It's just not my way. Some people it is. You got to find the right strategy for you. The third piece of the puzzle that you have to understand is, how do you now grow your money and how do you grow your wealth? This is where there's a lot of confusion around the idea of investing, partially because of people trying to sell products on the internet saying that investing is a way that you can get rich quick. That's not how it works. Investing is a way that you take the money that you have, you put it into this thing, that way this thing can start earning you a little bit of money. The more money you have, the more returns that your investments are going to make you. Your investments are not going to make you rich, but your investments can make you wealthy. And the difference between rich and wealthy is, rich is the ability to go out and buy whatever you want. Wealthy is the ability to have the freedom in time. So if I can get a 10% return on my money, which is a pretty good return, if I can get a 10% return on my money and invest $1,000, that means I'm going to make $100 over a year. If I invest $10,000, that means I'm going to make $1,000 in a year. If I invest $1 million, I'm going to make $100,000. Now that's a lot of money. $100,000 is a lot of money. But in order to get that $100,000, I have to accumulate that $1 million in the first place. This is where a lot of people get kind of swayed away from the idea of investing, because you always feel like, oh man, I'm going up this hill. Before I make any real return, I'm going to have to invest so much money, and there's no point for me to start now. But the reality is, slow, steady investments compound and can grow over time. If you started investing $100 a month when you were 21 years old, and you continued to do that until you retired, and you can get an average 10% return, which has historically been the average stock market return, you would retire a millionaire with over $1 million. And that's with the $100 a month investment. Now, when most people hear this, they say something like, but Jaspreet, $1 million 30 years from now is not going to be that much money, especially considering what's going on with inflation. I mean, $1 million 20 years ago in the 1990s might have been a lot of money, but now, after the 2020 pandemic, $1 million isn't going to be enough. And when I'm 65, it's nowhere going to be enough. But what you're missing is, this is assuming you're only investing $100 a month. If you work to earn more money and you get a raise every year, you also need to raise how much money you're investing. Which means now, as you increase your income, you also need to increase your investment. In fact, if you really want to become wealthy, the hack, quote unquote hack, to become wealthy sooner, is next time you get a pay raise, increase your investments before you increase your lifestyle. If you do that, now you have more money being deployed to build you that wealth, and you can get that wealth sooner rather than later. And now it's not just going to be the $1 million, it can be $2, $3, $4, $5, $10 million, depending on how aggressively that you can invest your money. But the key here now is you got to put your money to work. Now, where do you invest your money? You can put your money into the stock market. and this doesn't mean you have to go out and try to find the next Google or the next Amazon. There are ETFs or index funds. These are groups of companies. These are just funds that you can buy into that will give you exposure to the total stock market. There are funds that you can invest in that will give you exposure to the S&P 500, the 500 largest companies in the stock market. There are ETFs that will give you exposure to the Dow Jones. There are ETFs that will give you exposure to the NASDAQ. There are ETFs that will give you exposure just to dividend-paying companies. There are ETFs that will give you exposure to real estate. There are ETFs that will give you exposure to emerging markets, countries and companies overseas. And so now the game isn't you trying to find the best company, because let me tell you something. If you want to invest in individual companies, you have to be willing to put in the work, to do the research, to keep up with companies, to listen to the earnings calls, to study the financials. And I think most people, when they get into investing, what happens is you fall in love with the idea of being an investor and putting your money into something and seeing a huge return. And I fell into that same trap as well. And so now you start looking at, what you have, and you say, oh, I have Apple products, I have Lululemon products, I eat at Chipotle. Let me start putting my money into these things. And maybe some of them will make you money, but some of them might not. I was at a conference and the host on stage asked me, why can't somebody just invest in blue chip companies as opposed to investing in a fund? Because a blue chip company is a large company. They own a big share of the economy here in the United States. So why don't you just invest in individual blue chip companies, because those can get you huge returns? And you're right, they can, but they can also fail. Do you want to know another blue chip company that was one of the largest companies here in the United States? Sears. Sears was one of the largest companies in the United States. They were the disruptor in the United States. They had changed the game of retail in the United States, and today they are bankrupt. Why? Because every company, every country, and every currency has a lifespan. And when you're investing in individual companies, well, guess what? Technology has changed and shortened the lifespan as well. Even Jeff Bezos has talked about how Amazon will eventually fail. When? Nobody knows, but eventually Amazon will fail. Every company will fail. Artificial intelligence has changed the game again for businesses. What does that mean? The lifespan of companies that are not able to innovate, that are not able to keep up, that are not able to change with the times are going to see a shorter lifespan. So now your job as an investor is to buy into companies and find the companies that are keeping up and innovating and growing the products and growing the revenue and keeping that consumer interest. And maybe you'll get lucky and find a company that is, but maybe you don't. And this is where the real skill of an investor who is investing in individual companies is because now you're investing in researching the company, keeping up with the company, and doing all of that work. If you don't want to do that, that's okay. You don't have to. If you do want to, then by all means, go out, put in the work, and understand that you're taking on higher risk, because if that company goes bankrupt, you're going to lose your investment. But if you're not willing to put in that work, you don't have to. You can invest in funds that will lower that risk for you. And everybody talks about diversification when it comes to investing their money. Diversify, diversify, diversify. But the thing that you have to understand about diversification is that diversification is for people that don't know what they're doing. If you know what you're doing, you don't need to diversify, because now you're willing to bet on yourself. But if you don't know what you're doing, then by all means diversify. When you're investing in funds, you're not putting in the time and effort and research to find the best company, in which case now you want to diversify. That way you can benefit some of the winners and losers in that fund. If you don't want to diversify and you know what you're doing, then go out and invest in individual companies. That's okay, but understand the risk that you're taking. Now, if you don't want to invest in stocks, the alternative is real estate. I love investing in real estate. And by real estate, I don't just mean investing in paper funds or crowdfunded real estate deals. I mean actually investing in physical real estate deals. This can be going out investing in single-family homes, investing in apartment complexes, investing in office buildings, which are going through a major shakeup, and that will continue to be shaken up in the next coming years. There's a lot of opportunities in these places. Do you need more capital? Heck yeah. Does it take more work? Heck yeah. Does it require a team? Heck yeah. But it creates opportunity for the right type of person. When you invest in real estate, what do you get? You own a tangible asset, something that you can see, feel, and touch. When you own real estate, you also get cash flow. When I buy a rental property or I buy a real estate deal, I'm buying it for one purpose: cash flow. I want to buy this property that's going to pay me with rent after paying all my expenses, put some money in my pocket month after month after month. And the third thing that you get is you get tax breaks. Now, as an attorney, who's not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that our tax code has to offer. And in order for you to benefit from these tax breaks, you have to be a real estate investor. And I don't mean just going out and buying a home for you to live in. I mean going out and actually investing in a rental property that you're going to rent out to other people. But again, it's not for everybody. You've all heard people on the internet saying you have to invest in real estate, or don't invest in real estate, invest in stocks, or something along those lines. The people that are so gung-ho on that one investment asset class are generally the people that are trying to sell you some sort of thing to use or learn about that asset class. And what you have to understand is that there are people that became incredibly wealthy in the stock market. There are people that became incredibly wealthy in the real estate market, but there are not people that became incredibly wealthy just by earning a big salary. There aren't people that became incredibly wealthy just by paying off their home. Can a big salary help you become wealthy? Yes. But that means you got to take your salary and use that money to buy assets. The people that earned a big salary and became wealthy were people that took a piece of that income and they went out and they invested it into stocks, into real estate, into businesses, into startups, into something. That way they could grow beyond just their own incomes. And this is where now you got to understand, how does our economic system work? How do you benefit in a capitalist system? Because guess what? It's not just relying on your income, it's relying on your capital. That we can also take advantage of the tax breaks. Number two, you have to understand, how can you earn more money? But not just earning more money so you can drive a faster car, but earning more money so you can own more assets. Because there's a lot of ways that this money-making opportunities are going to change and are changing right now. Then you have to understand, how do you grow your money? Because it's not just about how much money you make, it's about how much money you keep and how you can grow your money without you physically having to work. Once you understand those three things, then you have to understand, well, what is the mindset that makes somebody successful versus somebody else? I had to fly into a small country in Europe called Estonia to speak at a conference. And on my way to Estonia, I had an 8.5-hour layover in Frankfurt, Germany. And because I had a long enough layover, I wanted to go out and explore the city because I'd never seen Frankfurt before. Now, what I did not know about Frankfurt was that on Sunday, which was the day that I landed in Frankfurt, a lot of people took the day off as a day of rest in Germany. People wanted to spend this day with their families and to rest because that was just a normal culture in Germany. So I didn't know this. I leave the airport and I go and get a taxi cab, and the driver happened to be from India and he spoke Hindi. So now he's telling me what's going on. He knew that I understood Hindi, so now he's telling me what's going on, and he's telling me, oh, you're going to the city square. Unfortunately, there's probably not going to be a lot of businesses open and not that many people there because most people take the day of rest on Sunday. I said, oh well, I'll just go explore. So he drops me off in the city square, and I got there a little bit early. And I'm walking around, nothing is open except for one bakery and coffee shop. And I walk into the store, and I don't speak German. And I walk into the store, and I start looking around, and the shop owner happened to be from Punjab, which is where my family is from in India. And he starts speaking to me in Punjabi. And I was like, oh, this is pretty convenient because I don't know German. You speak Punjabi, I speak Punjabi. Now we can talk about what type of croissants are good and what type of pretzels I should eat. So now I'm talking to him, and I get something to eat and drink, and I hang out there for a little while, walk around the square. A few other shops opened up later on in the day, but then I had to get back to my flight. And then I walk back to the taxi stand, and I can't make this up. I get back to the car, and I go to the taxi, where the taxi stands were, and I knock on the window, and I ask the guy, how far is the airport from here, or can you take me to the airport? He looks at me, and he can see, obviously, because I wear a turban, I have a beard, that my family's from Punjab, that I'm Punjabi, and he starts telling me in Punjabi that he can take me to the airport. And I was shocked now, because now the three people that I have done business with, from the first taxi cab driver to the bakery owner to this cab driver, were all natives of some sort of other country. All of the three of these were actually from India. And he starts telling me that he can take me to the airport. Now at this point, I'm shocked. I don't understand what's going on here, because I'm in Germany. And I thought that I'm going to be dealing with people that are native from Germany, with ancestry in Germany. Yeah, there was a lot of native Germans around there, but I kept dealing with people from different countries. And that's when it hit me. The people that were working on this day of rest were not people that were from Germany. They're people from other countries that want to make it in Germany. It was the immigrants who worked their butt to leave their country to come to this new country in Germany that wanted a chance to see success, to build their wealth, because they left everything for a shot at a new life. And now they're the ones that are working when everybody else is resting. And that's what I saw happen in Germany. And this is where now it made a lot of sense to me, because I think back to when my dad came to America. When my dad came to America, he had very little. He didn't know the culture, didn't know English, didn't know the people, left everything, left his family, left his friends, left everything that he know to come to a brand new country for one thing, the shot at a better life, period. I mean, there's no other reason why you're going to leave everything that you're accustomed to besides that opportunity. And people are willing to risk their lives to leave their home countries for a shot at a better life. Now, when you do that, you're not going to that new place, that new country to take it easy and chill and relax and live comfortably. No, you're going to go there to grind and bust your butt because you literally left everything for this one shot, this one opportunity, as Eminem would say. And so now you come into this new place, this new country for a shot, an opportunity, and you're not going to want to throw this away. So now when you go there with that type of mindset of risking and leaving everything, you're not going to want to leave a chance on the table for wanting to not succeed, for not succeeding. I remember when I was growing up, my dad would tell me, there's no such concept as a sick day. Because if you're taking a sick day, that means you're not working. If you're not working, that means you're not getting paid. If you're not getting paid, that means you don't got money to eat. Now, I was very fortunate. We didn't grow up poor or broke or anything even close. But I saw that mindset where for my dad and my parents, you work because you come with this opportunity and that chance. And so now, if you want something that nobody else has, you got to be willing to do what nobody else does. And that might mean you got to be uncomfortable. And we're in this day and age where working hard is kind of looked down upon, where people are kind of like, oh, are you sure you want to work on the weekend? Are you sure you don't want that work-life balance? Are you sure you should be working this late in the evening? Are you sure you should be putting in that much effort? You got to worry about all these other things. You need to get every 8 hours of sleep. You got to get all these things in your life. Now, don't get me wrong. Sleep is important. Your mental health is important. All these things are important. But they also play a part in different levels of your life and different stages of your life. In some parts of your life, guess what? You're going to have to sacrifice your sleep. In some parts of your life, guess what? Sometimes you're going to have to sacrifice time with your family. In some stages of your life, you might have to sacrifice time with your friends. This doesn't mean that you want to cut out everything and everything good and everything fun in life. But at some point, you have to be okay making sacrifices. And at some point, you have to understand when is that sacrifice worth it and what's not worth it. You don't want to go out and sacrifice your marriage for the ability just to make a lot of money because now you have a big bank account but no one to share that fun with. But you have to understand what is the right balance for you and when is that sacrifice worth it? And how are you going to make that balance happen? And that's the decision that you're going to have to make. When I was getting started on my entrepreneurial journey, I was not the smartest. I did not have the entrepreneurial guidance. I was always told, just study hard and become a doctor. Anything that's not medical related, anything that's not science or math, I should not think about it. So I had to do all of my entrepreneurial ventures in secret. I had to start investing in real estate kind of in private because I couldn't tell my family that I was doing these things because it was considered a distraction. So what did I do? I was going to school full time and running my business full time. I went to law school full time. I was running my business full time. And then I started taking night acting classes. That way I could learn how to be on camera. And you have to decide what is that sacrifice that you're willing to make. Think about any sacrifice any immigrant had to make who came from a foreign country. These are people that risked everything, left their parents, left their families, sometimes left their wives and their children, left their friends, left their money, left everything to go to a new country to find an opportunity, to create an opportunity because those opportunities are many times not there in the countries where people are immigrating from. People don't immigrate to a worse country. They immigrate to a country where they have more opportunity. And if you're in a first world country watching this video, you have the ability to understand what I'm saying. You're already blessed. The opportunity is there. Now, what you need to do is build that mindset of how can I capture that opportunity? Because guess what? If you're not willing to do it, somebody else is going to come and beat you. And yeah, I know in today's day and age, people don't want to talk like that because we want to feel all good and all happy and nothing's wrong and don't work too hard and get all your sleep and do all that stuff. You just got to figure out what's most important to you. In the beginning of my journey, I wasn't sleeping. Now I'm getting my normal sleep. And sleep is very important. Don't get me wrong, but you got to figure out what are you trying to achieve and what is it that you want right now. If you're going to make every excuse that everything has to be perfect and all the stars have to be aligned in order for you to go into work and do what you got to do, it's going to be very difficult for you to ever see any success in your life. And you're going to be the one that's constantly complaining and upset and envious because everybody else is willing to do what it is that you're not willing to do. And you're just going to hate on everybody else because they're putting in the work that you don't want to do. There's a lot of people that say work smart, don't work hard. It's a bunch of crap. You got to work smart, but you also got to work hard. And then you got to work in the right direction. And when you combine those three things, that's when nothing can stop you, because you got to build that mindset of doing whatever it takes. And that might mean sometimes you got to make some sacrifices. And then as you start to see some success, well, now you can decide, where do you want to pull up the gas pedal? When is it okay for you to spend more time with your family? When is it okay for you to spend more time with your friends? When is it okay for you to spend more time on vacations? There's a whole genre, what do you call this? A whole spectrum, not genre, spectrum of things, of lifestyles that you can live. And sometimes you got to make some sacrifices. And as you start to see more of the success that you want, now you can decide where on the spectrum you want to be. And I think we're going to see a big wake-up call in the coming years, because people have become very comfortable where we just assume that we deserve having the great work-life balance, that we should have the ability to buy whatever we want when we want, thanks to easy debt, easy financing, and that everything should always be okay, because we've always had this booming economy for the last 14 or something years, minus the little piece of downturn in the pandemic, which actually ended up being a big economic boost for the economy. But if you look at what's happening right now, we're starting to see big changes coming in the economy. These might not be immediate, but we're starting to see changes and shifts in the economy. Big banks are noticing the shifting tides in the economy. Take a look at this article from Financial Times. It says the largest U.S. banks are set to report their biggest jump in loan losses since the onset of the COVID-19 pandemic. The banks, JP Morgan Chase Bank, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley will set aside an estimated $7.6 billion to cover loans that could go bad, according to analyst forecasts compiled by Bloomberg. These are some of the biggest banks in the world. And you have to remember that when they're putting these billions of dollars aside, that's money that they cannot use to generate revenue. Because the way that banks make money is that they lend money out. And when they lend money out, they generate interest back. And so if they're not lending money out, they're not getting any interest back, which means less revenues. So if a bank is not going to be putting money out, there has to be a reason why. And the reason why here is because they're worried about loans defaulting. So they want to have money to protect them against the loan losses. This is where you're probably wondering, everything looks like it's booming in the economy. Why are banks putting money aside to protect them against these loan losses? Well, because of two things. Number one, because of the stalled impacts of higher interest rates. And number two, because of slowing consumer spending. We've seen interest rates rise pretty significantly over the last couple of years, and we have yet to see the full impact of these higher interest rates, and banks are thinking that these higher interest rates are going to cause some commercial landlords, some business owners to default because they're not going to be able to continue making their payments. And then number two is consumer spending is slowing down. Now, consumer spending is one of the main drivers of our economy, because our economy runs on spending. When you make money, and you go to Chipotle, you go to Lululemon, you go to Sweetgreen, and you spend money and you buy the extra guac, well, guess what? These companies are making more money because you're spending money there. And if you don't spend your money there, maybe because you lost your job, maybe because you want to save your money, or maybe because the cost of living for your rent and your car and your gas and your groceries are so much more expensive that you have to stop going out and shopping. Well, if that money stays in your pocket or it stays in your bank account, or if you don't have that money, that means Lululemon, Chipotle, Sweetgreen stop making money. And if they stop making money, they're not going to be able to continue expanding and hiring more employees. In fact, they might even have to downsize. They might have to shut down some stores. They might have to lay off some employees because they stop making money. That's why we live in a consumer-driven society where the more people spend, the more businesses make. In fact, our entire economic system is built around this. We live not just in a consumer-driven society, but we live in a credit-based society where consumers, regular people, have the ability to spend not just based off of how much money you have in your bank account, because that would be boring, but based off of how much credit you can qualify for. You might only have $100 in the bank, but you might have a $1,000 line of credit with your credit card, which means you don't just have the ability to spend $100, you can spend $1,100. What does that mean for the economy? That allows the economy to boom in the short term because now you have way more spending ability. More spending ability means more purchasing power, which means more boom and growth in the economy and businesses. And that's what we've been seeing happen. We've been seeing the economy grow, incomes rise, credit worthiness also rise, spending boom, especially for the last few years. We've seen incomes rise, and there's more jobs than really ever right now, which means everybody has a job who wants one. Maybe it's not the job that you want, but everybody has a job who wants one. And the reason why there are so many jobs out there is also because of, well, partially due to all the money that was created in 2020 and 2021. When you give businesses billions and billions of dollars, what are they going to do? They're going to create more jobs, open more stores, open more research and development plants, open more factories. That way, they can continue producing their stuff because they're going to want to make a return on their money. And so we have all this excess money that was given to businesses that created all these jobs. But so we have all these jobs that are created. Maybe it's not the job that you want, but people who want a job can get a job. People have incomes. Incomes have risen in the last few years. Maybe it hasn't risen as fast as inflation, but they have definitely risen in the past few years. And then because incomes have risen, credit worthiness has also risen. So banks, credit cards are looking at people's incomes and saying, you're making more money? How about another home equity line of credit? How about another credit card? How about a bigger line of credit on your credit card? So what does that do? More spending ability. Well, that's what's been happening. But now, in the second half of 2023, we're starting, keyword, starting to see a shift. Now, that shift initially was kind of triggered by the higher interest rates, but now we're starting to see a shift because consumer spending is starting to cool down. And the reason why consumer spending is starting to cool down is because the prices of everything have risen so fast. We've had so much demand from all the inflation that has happened, right? There was so much money created. People wanted to buy things, and people were willing to pay the higher prices for things because they had the ability to do so, and people just kept buying. Now, this doesn't mean that people had the ability in their bank account, but they had the ability through debt. And now what we're seeing happen is that people have been spending so much that they're having to dig into their savings to continue spending, not just to buy big lavish things, but to make their regular purchases. In addition to that, people are digging deeper and deeper into their credit cards to continue living their lifestyles because we've seen all this inflation and now people are starting to see this kind of imbalance in their finances. This is kind of, I'm speaking in generalities, but we're kind of seeing this happen where more and more Americans are saying, my income is no longer enough to continue funding my lifestyle. So what do? Do I cut back on my lifestyle or do I go into debt and dig into my savings to continue funding my lifestyle? And statistically, what we're seeing happen is more and more Americans are saying, all right, yeah, let's just dig into our savings and let's go into credit card debt to continue funding this lifestyle. That's why we're seeing now savings balances get reduced and we're seeing credit card balances skyrocket. Eventually, this is going to hit a breaking point. This is one of the reasons why now we're seeing consumer spending slow because eventually people are going to get tapped out on how much debt they can spend. And people eventually are going to tap out of their excess savings. In fact, there's a pretty big consensus amongst big banks that by the end of 2023, that the vast majority of people's excess ability to spend is going to be gone. Goldman Sachs says that by the end of 2023, 65% of this excess money and spending ability is going to be gone. Now, what does that mean? If people's spending power goes down, that's going to hurt the economy's growth potential. Now, we did a full deep dive of this in market briefs, but this is so important for you to understand because consumers are what drive the economy. And if consumers cannot continue spending or continue growing spending or continue funding the higher prices of things, that can cause a break in the economy, which would cause then a domino effect. Now, if you have not joined Market Briefs yet, it is my free newsletter that I created to keep you up to date on what's happening in things like the housing market, the stock market, the general economy. That way you don't get blindsided by what's happening in the economy. It's completely free to read. It's super easy to read, and it's going to keep you updated on what's happening in less than 5 minutes every morning. So if you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, and I also got the link for you down in the description below. But let me add one more variable into this, because now not only are people's incomes not rising fast enough for the cost of livings, people are digging into their savings, credit card debt is rising, but then this October 2023, student loan payments are restarting, which means we have millions and and millions of Americans who have not made a single student loan payment since before the pandemic have completely forgotten about their student loans, who are going to be hit with an additional $450 a month charge, maybe more, maybe a little bit less, depending on how much you owe. But let's just say $450 a month because that's around the average student loan monthly payment. Now what? We're hitting a time, inflation is still high, the prices of things are rising. People are digging into their savings. People are digging into their credit card debts, and then people get slapped with an additional student loan payment. And if you're not prepared for that, which I'm going to give you a little bit of advice on this, start preparing for your student loans before your student loans start. That means start putting money aside while you still have the 0% interest rate. That way you can aggressively attack your student loans, because if you can pay down your student loan balance before the interest rate starts, you're going to have less money to actually pay back and less interest that's going to be charged to you. So start preparing before the student loans actually start. Be aggressive about it, because you have this opportunity right now between now and the beginning of student loan payments to start paying down your loans. That way you have less balance left over. So start preparing today. Pretend like the student loan payments have already started and start putting money aside for that. But all these things are going to play a factor. And so now you start calculating, what does all this mean? Spending is starting to slow. Credit card debt is rising. Savings levels are dropping. Student loan debts are about to restart. These things are going to play a factor in the economy, all while we're also seeing higher interest rates. In fact, interest rates could potentially and should go higher, because we're still seeing the impacts of the high inflation. And so now if we continue to see higher interest rates, that makes borrowing money more expensive. It makes your credit card debt more expensive. It makes buying a home more expensive. And that also hurts businesses. It hurts businesses because businesses don't have 30-year fixed rate mortgages. Businesses have adjustable rate mortgages. And so now if businesses see a slowdown in their revenues, they see a slowdown in their profits, they could also see a rise in their expenses, not just because of inflation, but because their debt payments have gone up. Why? Because their debt servicing costs have gone up because interest rates are higher. Same with commercial landlords. If you own office space, which again does not have 30-year fixed rate payments, your payments will readjust. And if they readjust at significantly higher interest rates than when you initially got them, that could pose much higher expenses for you as a landlord. So you can start to see how in the coming 18 to 24 months, we're going to see a lot of shifts in the economy. And this is where your job is to, number one, monitor all these things. That's what we cover in market briefs every single day. But then number two, understand this. That way you can start preparing. The way you prepare is by getting financially smart right now and by putting money aside. Getting financially smart means learning how to invest, learning what is a good investment? How do you capitalize on opportunities? What's stock market investing? What's real estate investing? But then also being prepared, meaning have cash aside. Have cash aside to protect you against an emergency, but then also have cash aside to be able to capitalize on opportunities, because when you see these types of slowdowns, that also creates opportunities for people who have access to cash. And it's kind of like a cherry on top, especially for those of you that are still watching this video. The Federal Reserve Bank also wants to increase unemployment, because that's one of the factors that they're looking at when it comes to inflation. The Federal Reserve Bank wants to cool down inflation, and one of the impacts of cooling down inflation is higher unemployment. That's why you keep hearing the Federal Reserve Bank saying that the labor market is too tight. There are too many jobs out there. So the Federal Reserve Bank wants to cool that down, meaning raise unemployment, which then trickles down to every other part of the video that I was talking about, because if unemployment levels go up, less people have jobs, less people have incomes, that means less people are credit worthy, and less people have spending ability. If less people have spending ability, less money is going into certain businesses. If businesses are making less money, that means their revenues are falling at a times where expenses could also be rising. Why would expenses be rising? Well, number one, inflation, but then number two, because debt servicing costs are rising. So these things are going to be playing out in the coming couple of years, which is why you need to be the one that's getting prepared and financially educated. There are three very clear points in my life where I learned a new piece of information which completely changed the trajectory of my life financially. And I'm going to go over those three in this video. Number one was when I was 16 or 17 years old, I read the book Rich Dad Poor Dad by Robert Kiyosaki, and then I read Total Money Makeover by Dave Ramsey, and that was the first